Hey guys, Nick Vail here, and today I'm going to help you remove the guesswork when it comes to a market correction. We are currently heading into the 100th month of a bull market. We are due for a market correction any day now, and in this video I will discuss what a market correction is, why we are due for one, and how you should respond when it does happen. So what is a market correction? There are a few types of significant market declines that would fit that description. The worst case scenario is a market crash. This is when the markets decline 30% or more from their previous highs. This is when most recessions occur. Now, a 20% decline in the market is known as a bear market. So you often may hear bull market or bear market. Bull market is a good thing, bear market not so good. Now, a market correction is any time the markets decline at least 10% from previous highs. So how often do these declines occur? Normally much more often than they have recently. We have not had a market correction, being 10% or more decline, since August of 2015. These corrections normally happen once a year, and now we're getting close to 2 full years. When they do occur, the downturn usually takes close to 4 months to go from top to bottom, so they do not happen overnight. A bear market or a 20% decline normally occurs every 3.5 years, but we haven't seen one in over 8 years. So what does this all mean? It means we are due. We are in the second longest bull market ever. All of the 6 previous longest bull markets saw a correction of at least 22%. Now, it could happen in a few weeks, it could happen in a year, but what we do know is that it will happen. And, it's a natural part of investing. So when the inevitable market correction does happen, what should you do? Because the stock market has been on a long bull run, it's easy for your stocks to occupy a larger portion of your portfolio than planned. So let's say you had 70% stocks or equities in your portfolio to begin with. Well, now because of this long bull run, maybe now they occupy 85% of your portfolio. While it's always great to have strong returns, you're also now subjecting yourself to more volatility risk. This is a bad thing if and when the market correction happens. So what should you do? The best thing you can do is not freak out when it happens. Investors are often their own worst enemies. We tend to want to pull money out at the first sign of trouble, and then we get back into the markets too late. Don't overreact and do that. This will exacerbate poor returns by turning a short-term issue into a much bigger long-term problem. If you don't have a plan for when markets decline, now is a good time to get one. If you aren't sure how much volatility your portfolio is subjected to, you should. Now is a good time to have a risk audit done to figure that out. I often find that most investors who tell me that they are conservative are actually fairly aggressive or even very aggressive once I find out and look at their statements. So something to think about. If you have done financial planning, you should just acknowledge that the correction is just a speed bump on your longer road trip. Your advisor should be monitoring your risk exposure in every meeting. If anything, a market correction could be a good time to put money to work that you may have currently sitting on the sideline. If you are already monitoring your risk and you're comfortable with where you're at, do nothing. Keep making your monthly contributions and realize that short-term issues are completely natural and expected to occur. Don't allow the talking heads on cable TV to influence you to make poor long-term decisions based on what's happening right now. Remember, they're selling headlines and ratings. So there you have it. As Jon Snow might say, a correction is coming. Be prepared ahead of time and you'll be in good shape. Thanks for watching. For more free content, check out removetheguesswork.com, subscribe to my YouTube channel, or like us on Facebook. We'll see you next time.